Hey guys, today we're going to do problem 4.1a. Okay, so we have a company here and we're going to prepare these financial statements. Okay, then we're going to prepare some closing entries, and lastly we're going to wrap up the accounting cycle by preparing a post-closing trial balance. So let's take a look at the company. Okay, so this is Beacon Company's adjusted trial balance. Right? So our unadjusted trial balance, we started out here, and then we made adjustments as we did in the last chapter to do things like adjust prepaid insurance and supplies to reflect the consumption of those, right? We recorded our depreciation, things like that. We reduced the amount of unearned rent because we had earned some of it. Okay, so we have our balances down here for our unadjusted trial balance. We made our adjustments, and now we have our adjusted trial balance. Now from this adjusted trial balance, we're going to prepare the financial statements. We're going to start out with the income statement because that's the first one that we prepare. And of course, we're going to we're just going to take the figures from this adjusted trial balance and plug them into the income statement. So we're going to start with the income items here. We're going to offset that income with these expense items here. Okay, and so this is what we're looking at. We have Beacon Company here. We have the name of the financial statement, and for the year ended October 31st, 2012. We've got the total of our revenue. We've got the total of our expenses. And the difference between those two was $137,800. So it took us $170,200 of expenses to earn $308,000. So this is our profit here for the period. Okay, for the period of time, for 1 year. From that, we take this $137,800 and we plug that into the statement of retained earnings. Okay, so remember, all of these are known as nominal or temporary accounts. Okay, we're going to zero all these guys out after we prepare the financial statement so that we can have the books ready to accumulate information on these guys for the upcoming accounting period, because this is only for a year. So each year we need to clean the slate so we can start fresh. Okay, so we don't forget about all of the performance for the year, though. We simply close these to retain earnings. So let's take a look at what happens here. So as we're preparing the statement of retained earnings, we use this number for net income, and that increases. We started out with $78,100. It's increased by this amount here. We're also going to have dividends that are going to decrease our retained earnings. And once we've made those changes, we're left with $205,900 for our ending balance of retained earnings. Now, this is going to find its way to the balance sheet. Remember, the balance sheet is essentially the accounting equation for a company, right? So when we look at Beacon Company's balance sheet, it's dated October 31st. It's a snapshot of this one point in time. We have all of our assets, we have our liabilities, we have our equity, and looky here, here's the retained earnings. Now you'll notice that this balance sheet is a little more complex than some of the other balance sheets we've seen before in the earlier chapters. They were pretty simplistic there. Here we have what's called a classified balance sheet, and we have the assets classified based on their character, right? So we have cash, accounts receivable, prepaid insurance, supplies. We could have inventory, things like that here. Now we list these current assets, which are assets that are expected to be consumed within the current year. We're going to take these guys and list them in their order of liquidity. Liquidity is the ease within which we can convert these guys to cash. So naturally cash is going to come first. We have a subtotal here for them. We list all of our property, plant, and equipment. Now we don't depreciate land, we've discussed that. Our building here is offset by this amount of accumulated depreciation. So the $200,000 reduced by its accumulated depreciation, and this is called a contra account, remember? This reduced by that gives us the book value, or what's known as the undepreciated cost, of $98,100. Likewise, we have a similar category here for equipment and its contra asset, and our book value is $12,700 for our equipment. Okay, So this accumulated depreciation represents all of the depreciation expense that we've taken on these buildings since we put them into use. Okay, we have a total of this category, and the two together equal $239,500. Of course, our total liabilities and equity are also going to equal this amount. So up top here we have different types of current liabilities. Those are liabilities that we're going to satisfy within the current year. We have our accounts payable, salaries and wages payable, unearned rent. We have our capital stock and our retained earnings. Now, by the way, we're getting all these figures from the adjusted section, the adjusted trial balance. Let's take a look back at that. Okay, see, here's capital stock, right? And we take this figure, and these numbers here are what we use to prepare those financial statements. Okay? Okay, guys, so upon preparing the financial statements, the next step in the accounting cycle is to go on and zero out those temporary or nominal accounts so that when we start the new accounting period, we're only showing the income and expense for that accounting period. Okay, so we need to do a couple things. We need to eliminate the balances of all of the revenue accounts. We do that with this first entry here. Okay, we use this account called an income summary account. It only exists during the closing process, and then it goes away. Okay, so we're going to offset these revenue accounts that had a credit balance. We're going to zero them out with the debits. The next step is to zero out all of the expense accounts. They normally had a debit balance, so we credit all of them, and the offset is income summary. The difference between the income and the revenue that we've put into this income summary account is $137,800, and that's our net income, wasn't it? Okay, so now the next step is to close the net income from the period to retained earnings. That's what we're doing at this point. At this point, we are zeroing out the income summary account, and now its balance will be zero. It only exists to assist us in the closing process, and then we forget about it for the entire next year until it's time to make these closing entries for the next accounting period. We can't forget about dividends. We know that dividends negatively impact retained earnings, and we know that we need to wipe this account out also so we can look and see how much dividends were paid for each year. So instead of using the income summary account, we just close these guys directly into retained earnings. Now, the reason that we do this is that we want the income summary to reflect the amount of net income. If we include dividends in the income summary account, well then the balances would not reflect net income. Okay? Now, after we've gone in and made these closing entries, let's take a look at what our post-closing trial balance is going to look like. Just like any other trial balance, we have a column for debits, we have a column for credits. Okay? At this point, we have zeroed out all of the temporary accounts. So we're not going to see any account that has a zero balance. We're just not listing it here. So we're not going to see our dividend account because we zeroed that out. We're not going to see any revenue accounts. We're not going to see any expense accounts, are we? We haven't forgotten about their effect on the company, however, because remember, we closed everything into retained earnings. So now we list retained earnings last. And this amount here, we started with our beginning amount of retained earnings, right? And it was increased by all of the expenses, all of the revenues, and all of the dividends for that year. That's how it affected our company. And now this is the accounting equation for our company. And as we begin the next period, we have a clean slate so that we can record our revenues and expenses for that period. It's important that we are able to distinguish the net income and know which period it belongs with. Okay, so that's why we need to clean the slate. And so this is October 31st, 2012. So when we're preparing the financial statements for October 31st, 2013, our profit and loss statement, our income statement, should only show profit and loss items that relate to that year, to 2013 and not to 2012. We're able to accomplish that because we've cleaned our slate and zeroed out all of those accounts in preparation for the upcoming year.